Are capital gains from stocks traded inside an IRA taxable at the end of the year?
I get this question pretty
Yeah,
frequently.
it's kind of neat that we get this because people are thinking they're worried about capital gains, but they're forgetting it's in a retirement account. So what happens? Nothing. Exactly right. Because if your stock can go up, 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 Bitcoin, 2 years ago, 80,000, all that gain. If it was in your retirement plan, there's no tax until you retire. Even if you sell it, there's no gain. It grows tax free until you distribute it to yourself. That's where the hammer comes down with taxes. So not a problem here at all from gains as long as you haven't distributed anything out of your plan.
Yeah, realized capital gains mean nothing inside of an IRA, any kind of QRP. It also means nothing inside a nonprofit. Mm-hmm. Now, the one disadvantage, and it's just a slight disadvantage, is capital gains to you personally, if they're long-term capital gains, get taxed at a much lower percentage. When you pull all these capital gains out of your IRA, you're pulling at your regular tax rate, not the lower capital gains rate. So, and it's kind of a trade-off.
And it is always that's as far as tax planning, that's always that big issue. Do I think rates are going to be higher when I retire or lower? Toby gets hit with that. I know all the time because I see it on, tax wise and all that, and here with Jeff on Tax Tuesday. Should I do a Roth or whatever? You're always playing that game of, do I think taxes are going to be higher or not? And we don't have that crystal ball, but I believe, Toby often talks about, he's done a lot of research and cracked a lot of numbers. Often, if you're older, there's probably no use to going into the Roth. If you're trying to do a conversion into a Roth, it's probably not worth it because you have to make that back up, that amount of tax you're paying. So just some thoughts, but directly to the question, if you just have gains and you haven't taken anything out of your IRA, that all grows tax-free until you take it out later on in retirement.
So what is the one time that I'm going to have to pay tax in my IRA?
Well, okay. And if we do different types of investing, where maybe we invested in something that we talk about capital gains here. Well, what if it's something that didn't create capital gains? What if it created ordinary active income, like a real business? Take Toby's famous pizza shop. If you invest in something like that, an active business, you could have what's called unrelated business taxable income, or UBIT, sometimes depending if you turn the INT around. There you're going to get hit with heavy taxes, and it's the brackets aren't much higher than regular. It's just that they rise really fast. So by like $10,000 of income, you're at 40% tax bracket or something, and it's critical. And the whole idea is to punish those who invest in that kind of thing, because the IRS needs a level playing field, or Congress wants a level playing field between Toby's pizza shop that's out in the private world and one that's someone who's investing in one through their retirement plan.
So I have a couple investments in my portfolio, not my retirement portfolio, my regular portfolio, Sunoco Limited Partnership, All American Pipeline, and a couple others. These are almost all publicly traded partnerships, and they usually have limited partnership in their name. Now, I'm not giving investment advice on this. They tend to pay pretty decent dividends because of the nature of the business, but they also generate exactly what you said. They generate ordinary income, sometimes ordinary losses, which is not a big deal. But if I have this, we'll take Sunoco in my trading account or my IRA account, and it's generating ordinary income, because these limited partnerships send out K1s even though they're traded on the stock exchange. I have to report that ordinary income as unrelated business income, which gets taxed. What's a percentage on that?
Well, again, it is a bracketed, but it grows really fast. So it's on, I think, what we call trust rates. And I don't know the exact brackets, but I believe the highest is 40% or 37%, something like that. It's up there. But again, it takes very little time to get up there, like $10,000, $15,000 or something like that. Grows very fast.
So my advice is, if you have anything in your retirement accounts that say limited partnership, I know you bought it on the New York Stock Exchange or whatever, Kinder Morgan's another one. You may want to dump those puppies.
Yeah, unless they're making a ton of money. If you're making a ton of money and getting taxed for it, well, you're still gaining.
Yeah.
That's,
Because I don't think people even realize what they bought until they've already bought them.
how often I kind of say that.
So yeah, that's the one time you may have to pay tax out of your IRA. The other time is the qualified, the interest one, the financing one.
Yeah,
QDIF.
yeah. You unrelated debt financed income, which is really considered a subset of UBITs, but it's directly related to when you have debt involved. Want to go into that further?
Yeah, from what I've seen, it's where disagree if you think I'm wrong.
No.
I'm getting income from this entity that was paid for by financing. So they went out and got a loan for $100 million and then paid out distributions to their partners or shareholders with that money. That income becomes taxable.
Yeah, the amount, it's a ratio between the amount for the project that was financed with cash from the investment and how much was from debt. And you have this ratio, and the amount, let's say you get $100 of income and it's 50, well, we'll say it's 60-40, 60 cash, 40 debt. Well, then 40% of that income or $40 will be subject to this UDFI, which is that same super accelerating tax bracket. With $40, you're already taxed at some crazy amount, like 25% or something like that. Takes a little time to get up there. And so I believe if you look through and you do enough research, and I don't know why anybody would, but I think UDFI is really just a subset of UBIT. It's just that UBIT's the most popular one. You don't hear as much about the finance, but happens a lot, especially with clients in our realm who might be going into investments in where they're real estate, where they've taken on a lot of debt to build maybe a syndication or something like that. And they did it with an IRA. They did the investment there. Could be an issue, something to be aware of.
And UDIF only affects IRAs, not 401ks, correct?
My understanding is that you can get in these very narrow circuits where you might get hit with it in like say a solo 401k, but it's far more unlikely that you run into UDFI in there. Just different rules, different kind of thing going on with a solo 401k. But the IRA is the one that really gets hammered with it typically.
If you're investing in your typical common stock, preferred stock, bonds, if you're doing options, all of that's going to be non-taxable while in the IRA. So all that typical trading stuff, it's just a few of the, we'll call them the weird items that can get you into a bit of trouble.
Yeah. So again, coming all the way back around, capital gains typically no problem in your IRA. We want those. They just grow and grow and grow tax-free, unless you get into some kind of investment that has unrelated debt taxable income, or unrelated debt finance income, where you might get some tax on it, and at a very high rate.